I'm very excited to bring up fellow Keiretsu member, Michael Grenier. Michael is a Northwest member out of the Portland chapter. Michael is also the founding partner of Blue Ox Ventures, an early stage clean tech investment firm. Mike serves on several boards and is an active startup mentor, an angel investor, a serial entrepreneur with multiple successful exits, and a 20-year career that spans software, venture capital, wind energy, solar energy, and project finance. Prior to founding Blue Ox, Mike was the co-founder of Smart Energy Capital, a leading distributed generation finance and development company that was acquired by NextEra. Earlier in his career, Mike founded Sunworks, acquired by Amonix, and led the creation of Sun Edison Europe, one of the first employees at a wind developer. So wind developer, Ridgeline Energy. So we're excited to have Mike with us today. I'm going to stop my screen share and turn it over to you.
All right, so hi everyone, Mike Grineer. I'm a founding partner of Blue Ox Ventures. We're based down in Oregon. My partner and I have been doing clean tech for about the last 20 years and had a few companies before that in software and hardware. We're, as Brianna mentioned, a clean tech investment company. We're not your typical venture capital firm. We have a kind of a different model, but because we've been in this business for a long time, we just see a lot of opportunity because we believe that the whole world's beginning its transition from the old fossil infrastructure to clean energy infrastructure. And that's a $15 trillion ecosystem that's going to need products and services and software to support it and help it grow and scale. We already went over my overly lengthy bio, so we'll just skip that. My partner Casey is an engineer by training and has a great products background at HP, and then grew several inverter companies in the solar space. So let's talk about valuations. So I'm going to talk about the VC or the venture capital approach today, and I think you're going to hear about some other approaches today. This is one approach you can use. It's, in my experience, a pretty decent way of thinking about startup valuations, where you're really looking at companies, going up in rapidly changing what they're worth over time, and it's way more qualitative, I would say, than quantitative. And this isn't the only kind of investing we do, but when we are dealing with a startup company, this is definitely the approach we go to first. And so the first principle here is a company's worth what somebody will pay for it. And so we really start with, well, what, if this company is successful in its vision, and 3, 4, 5, or whatever years from now, it has thousands of customers and it's generating revenues and it's profitable, and some bigger fish comes along and wants to buy it, what's that going to be worth? And I'll just put an asterisk there is we never ever value a company based on the possibility of an IPO. That we just think of as a really nice upside outcome, and if it happens, wonderful. So we spend a lot of times focusing on what will somebody pay for it, and that's really about understanding who the universe of buyers are for a given type of company, and there may be more than one category of buyer. So for example, we looked at a company that had a specific type of monitoring equipment for solar projects, and we said, well, this could be sort of part of the ecosystem of hardware companies that sell the solar projects, and this could be part of that monitoring hardware, or this could be a data company, and people could look at this and say, oh, this is data, this is going to be AI analytics, and somebody's going to pay for this as a pool of data that they can monetize over and over again, selling additional services. So it's important to identify sort of different categories of buyers, and then you want to dive in and do your research and try and figure out who have they bought before, and what types of companies they bought before, what did they pay for them, and you try to understand their motivation behind that acquisition. Were they buying, like if we go back to Web 1.0 days, right? People were buying for eyeballs, and that was a common metric. In a SaaS business, which is super popular right now, right, is a multiple of annual recurring revenue, or ARR. In more traditional businesses, it might be a multiple of EBITDA. And in my one of my former businesses, renewable energy portfolios, your project portfolio, your asset portfolio was valued on a dollar per megawatt basis. So the important thing here is just to understand what, who was buying, what were they paying, and then try to understand their motivation so you can come up with a multiple. And when we're going to apply that multiple to the company in, its projected year 5, and work our way back to today and what would be willing to pay for it so that we think we get our expected return. So now comes a little bit more of the art than the science. So, we always like to get our hands on the company pro forma right away. And we want to understand the key drivers in that pro forma. And that there's a lot of time that we spend trying to think through, okay, do these really make sense? Is this really how the company is likely to grow? Is this really possible, practical, feasible? But at some point, you end up with a spreadsheet and it says, well, by year 5, we think it's going to be at X. And X is the metric that for your comp that you did before. So, right, if this is a SaaS, let's just stick with a SaaS company. What is the ARR projected in year 5? And then what that company is worth in year 5 is that ARR times the multiple that you got from your comp research. And so then the other piece you need to understand is, well, how much money is required to get there? So again, you go to pro forma, right? You're going to hire a bunch of people. You're going to burn through a bunch of cash. Hopefully revenues are going up. Hopefully you're hitting cash flow break even. And you probably need another injection of capital along the way, because you're going to say, hey, great, this works. Now we need more salespeople. So now we're going to hire a whole bunch of salespeople. We need a little money or a lot of money maybe to go do that. And so there'll be a multiple injections of capital along the way. And you have to have a little understanding of as people come in later, kind of what price they're going to be willing to pay, or based on their return they expect. And you work backwards to say, okay, basically, how much of this company do I need to buy for the amount they're raising for this to hit my return target, right? So let's say the company is a Series A, they're raising $3 million. What I really think in terms of, well, do I need to buy 20% of this company, 25, 30, 35% of this company, so that by the time we get 5 years down the road, we've raised additional capital, I'm going to own some percentage of that company. And when it sells at 10 times ARR, the cash I get out of that transaction is going to hit my return threshold. And then of course we run scenarios around that. So I find the best way to go through valuations is really just go to the spreadsheet. So let me transition here to that. And if you can't see this, or Brianna, is this coming through clear? Big enough? Okay.
Yep.
Great. So this is, believe it or not, you can do really fancy spreadsheets to try and come up with these numbers, but for better or worse, these simple spreadsheets often come out just as good as the sophisticated ones. And so, and I know some of the other speakers are going to talk about this, but we really break this down into 3 parts. So first of all, this is the fundraising part. So let's say you have a company and they're out raising and say, oh, we want to raise $4 million and we're going to sell 30% of the company for that. And let's assume we're just price takers here. We're not able to really negotiate the term sheets. Well, you'd look at that and you'd say, well, if it's $4 million for 30% of the company, you do some math. And what that means is they're saying the company's worth $9.3 million now. And after you put $4 million in, the day after, it should be worth the 9 plus the cash that just got injected into the company. And I'm happy to share this spreadsheet afterwards. I'm going to go through it quickly and I'm going to try and leave a little time for questions. And then from the pro forma that you've been looking at and thinking about the cash injections along the way, you will pull from that pro forma some assumptions about how much money they need along the way. So let's say they're going to raise another 10 million, and then as they grow another 25 million. And each step along the way, they're selling another chunk of the company, but they're doing it at a different share price, right? A higher share price every time. And where you see that happening is in the pre-money valuation as you go from a $9 million company to a 20 to a $75 million company. And of course, I'm modeling the happy case scenario here where everybody likes the outcome. And then in this table here, it shows how the ownership of the company is changing. So it starts out, right, it's just the founders, and then the Series A comes in and they buy 30% of that 30% of the company. And then the company grows, it gets you sell at a higher share price. And so the Series B comes in for 32% of the company. And then you can see what's happening along the way here is that people are getting diluted. And diluted is often used as sort of a bad term. And what I would say is dilutions, as long as things are going well, dilution's a good thing. If things are going bad, then dilution's a bad thing. And so the focus for me, I don't get too focused on dilution so much as really understanding the key valuation milestones the company needs to hit, and are they going to get there? And are they on track to get there? But as you can see here, right, dilution, the common goes from owning 100% of the company to 36. If you're a Series A investor, you go from owning 30 to 15. But as that's happening, the value is going up too. And the value, what you're looking for is the value accretion is greater than the dilution. And then, so here is the working backwards part. So let's say we did our research, and let's say we found out that companies are selling for somewhere between 5 and 14 times ARR. And you can just create a little data table that says, well, let's say in year 5, the company's got 25 million of ARR. Then what happens is you say it's 5 times 25. And so the company would sell at 125 million if that was the offering price. And so this is where you're running scenarios. And so you say, well, it might be 5, it might be 14. And I'm setting a big range here, just mostly as an illustrative exercise. So that's what the company sells for. And then, well, what's your take at that exit? And that's just your ownership at that time times the value, times the total sale price of the company. So in this case, the Series A owns 15% after the final round. So 15% of 125, 19.3. And so you can see that a Series A could start to think about an exit opportunity somewhere between the $20 and $53 million range. And then a lot of VCs really think in terms of cash on cash returns rather than IRRs. And so down here, you just calculate your cash on cash return. So if you invested 4 million, if the Series A was 4 million, when it's sold, it is getting somewhere between 4.8 and 13.4 times its money back. And what this example shows is what I would call sort of a typical or perfect type of scenario where the Series A sees larger cash on cash multiples, Series B sees a little bit lower, Series C a little bit lower, and that is all the risk return balance, where Series A took more risk, so they're solving for a higher return. So what we would do is we would look at our ARR valuation, and we would look at how much is the company, what percentage of the company is getting sold, and then is this set of, let's say we're the Series A investor, we would say, well, hey, is this range of outcomes meet our return threshold? And that's how we decide if up top 4 million on a 9.3 pre is a good price or not. So I know I blew through that really, really fast. And so I guess with however much time we got left, I'd love to just take questions and have it be a little bit of a discussion.